Hello and welcome to Crux Investor. We caught up earlier today with Fred Bell. He's the CEO at Elemental Royalties, TSXV listed royalty company focused on precious metals. We talk about the South 32 acquisition, which has gone through. They raised some money recently too, refinancing out the Sprott debt and what the future holds for them. If you want our thoughts and opinions on the conversation, the company itself, and indeed the CEO, you can find that at cruxinvestor.com/club, where you can also find detailed company reports and analysis. There's commentary from experts from around the world on a variety of commodities and companies, including royalties, which you'll find insightful. We've got training courses to help you with your own diligence process. We've got summaries of other interviews that we've done to save you some time, because we know you're busy. And if you want to join a thriving community of investors sharing their thoughts and ideas with each other in a nice, safe and friendly environment, you can do so at cruxinvestor.com/club. Do go and have a look, because I think you'll like it. And we'd love your feedback too. So do give us a like. It would be appreciated. If your thoughts below, we'll get back to everyone. And if you want to see what precisely we talked about today, take a look in the description below. Fred, how are you, sir?
Very good, thanks, Matt.
Wonderful. How are you coping in London? Riddled with Corona. I haven't been back since March last year.
Yeah, probably not too far from you. I'm probably a similar position, but definitely looking forward to travel opening up and being able to go to not just to Canada or the US, but I think actually to mine sites in due course as well, and see some of the projects we've got royalties on, which we haven't been able to do in the past year at all.
Yeah. Well, I mean, since we last spoke, you're no longer the new boy in the block. You've had to do a bit of growing up.
That's right. I think the South 32 transaction was a really game-changing acquisition for us. That was the size of the company. We have a new just under 20% shareholder who's a major miner, and I think all the benefits that both that deal will bring to us, but also I think going forwards, I think opportunities will come out of it. So very, very different to where we were 3 months ago, very different that was to 6 and 7 months ago when we listed, and then a year ago today when we were still a private company. So a lot's happened over the last year, and even working from our living room here in London.
Well, we'll get into that. We'll get into it, okay? But again, for people new to this, Royalty Week, we're talking to royalty companies. Give us a 1-minute overview of what you've got there, and then I'll pick it up with some questions, okay?
So Elemental is a royalty company that listed in the middle of 2020 on the TSXV in Canada. We have a portfolio now of 9 royalties. I think the real differentiator for us is that most of those are high quality producing assets. And so straight away, if you look at the sub-billion-dollar royalty space, Elemental's the 3rd highest in revenue, but we're probably only the 7th or 8th in terms of market cap. So I think that's a real differentiator for us from the beginning. We've gone for a smaller portfolio of good quality producing royalties, and that gives us the diversified foundation of revenue to build the company up from. So it's by no means the easiest thing to do. In fact, it's the other way around. It's by far and away the hardest thing to do. Producing royalties are like mines. There's 10 exploration ones for every actual operating mine there is. And so always hard to do, but we've done that over the past couple of years, and I think it puts us in a really good stead going forwards.
Right. So let's talk about some of those challenges that you face as a young, small company. You're private for a while, went public last year at TSXV, which is great. But you chose to make a couple of acquisitions. I mean, you've done it twice now. You've sort of doubled the size of the company twice by making acquisitions of equals, as it were, right? The most recent being South 32. Do you think you overpaid for that?
No, I think if you look back at the deals we've done, actually one of the ones that internally we sort of had a lot of debate on the price on was the Wang Yon royalty that we bought at the start of last year. And we actually negotiated for a long time on the price on that, and we really sort of tossed it backwards and forwards. And if you look at it today, it's a royalty it's probably maybe a 6 or 7 year payback, and it's a royalty that, with the acquisition of Teranga by Wang Yon, not only does it have a 10-year mine life, but it's also, they've just announced a really material exploration program on it for the rest of this year. So that is a mine that will probably, in our view, still be where it is today in 10 years' time, and still have the mine life ahead of it in 10 years' time, but will be fully repaid in 6 or 7 years. And that doesn't always come through. initially when you buy it. And often people say with royalty, especially good quality royalty acquisitions, you're paying a full price for it. But the best royalties are the ones that actually often what you pay at the beginning is because of the exploration potential. It's because of the management team. It's because of the operator. And it gives you all the benefits that a royalty should in terms of optionality going forwards.
Right, because some of the CEOs that I've spoken to out there in the market felt that was an expensive acquisition. Can you justify it as being the right price for you because it delivered something else, which gave you a critical mass of size to get you noticed?
Yes, and if you look at Elemental's history to date, so since we started the company, I think we've got the best track record of adding value for shareholders in the acquisitions we've done. And that is in our presentation. It's undisputable based on where we've got to today. If you look at Quale, it's probably a 40% plus IRR. I think by the end of next year, 3 of our royalties will have fully repaid us on the acquisition cost. And those are operating mines still going. And so, again, it's easy to say, okay, well, you're buying a royalty on Australia's newest gold mine. That looks expensive. But actually, in 2 years' time, that might look like a really good deal. And if you look at the deals that we have done to date, that I think is borne out in some of those acquisitions and in what they have delivered to us. And the other aspect is as well, we're getting to that inflection point where we had just over $5 million of revenue last year. So the third highest in sub-billion dollar market cap. And when you're at the stage we are now, every $1 million of revenue that we add in terms of going forward to royalty revenue, every $1 million of royalty revenue we add, we're seeing sort of 90% of that as free cash flow because our costs are relatively fixed. And so we're at that point now where if we double our revenue, we might actually be tripling or quadrupling our free cash flow. And you really start to get the benefits coming through. Whereas the problem is and this is why we started privately, when you start and you have $2 million of royalty revenue, you're always using that to sort of pay your costs just to tread water. And so you're diluting yourselves every time. And we want to get to that dream position where we think we'll be second half of this year, where we have enough revenue, 10 million plus on a go forward basis. And that puts us in a position where we can really start to use that to reinvest as we go forward. So it puts the company in a very different position to where we were. The Wang Yuan acquisition did the same. And I think that if you sort of look forward in a year's time, similar to the Wang Yuan acquisition, I think you'll be able to see the value come through out of that.
Right. Okay. So it'll take time to manifest itself. And it's a question of what you do in that intervening period. So, but I do feel there's a disconnect between what you're telling me and what the market's doing. Because when we spoke in November, share price 179 down to 139 today. It's been a fairly erratic ride down to this point. I mean, what's going on?
Yeah, so just to context for everyone, we started at 2020 when we were still private. I think we did a $1 fundraise, and then we listed at $1.30 in the summer of last year. And then since that, and we're public then, so you can see the prices sort of been up 180 to sort of 130, 140 sort of price range, and that's about I think where we are now, and 140 range. And I think that if you look at the assets that we have, these are really high quality royalties producing assets. And on any of the valuation metrics at the moment, Elemental is standout on value. And I think that there couldn't be a better time for someone to actually invest in the company. If you think that in Q2, we have our biggest royalty coming on stream in Australia, which will more than double the revenue of the market cap, double the revenue of the company going forwards. If you look at some of these assets, as they start to come on in the next year, and we've already paid for these, we have a lot of organic growth in there. And that, I think, is absolutely key for investors to look at. And you can buy us at almost the same price as you could when we listed last summer. So it's a really good value proposition. And if you look at what the directors are doing, I think directors and management have probably spent maybe $2 million since we listed, sort of investing in the company themselves. And that's at higher prices again than it is today. So there's no doubt that we believe where we're going. There's probably 16% of the company is held by directors and management. And so I think with these royalty acquisitions starting to come through over the course of the next 6 months, you should really see that reflected in our price.
Right, and obviously gold's come off a bit. Precious metals have come off a bit since November. I think that we'll throw that into the mix too. But I'm trying to get you to explain to me why life is going to be great going forward. Okay, so of the projects that you've got, let's look at the next 2 years. How many of those have JORC compliant or 43101 compliant resource numbers on them? How much drilling is happening at those? How much money is being spent at those? And how do you kind of quantify or work out when you're going to see some level of contribution from them?
So I think that's a key differentiator for Elemental. Our royalties are not, you look at the portfolio, they're not exploration royalties, which might come in, everyone knows the mining space, they might come in 5 years, they might come in 10 years. I can remember going to analysts, brokers 10 years ago, and I saw a tombstone on the wall for development financing. And I went in there when we could still travel 2 years ago, and they'd recently done another development financing package. So the difference with Elemental is that the majority of our royalties are on already producing mines. And of the royalties we bought from South32, the largest one, the majority of the value, is currently more than halfway through construction. It's commissioning in Q2. So it's commissioning in Q2 2021. And that will double our revenue almost going forward. So what you see there is that straight away, we have a portfolio that is really de-risked. It has good quality producing assets. And the great thing about that is the operators then, when they find another 100,000 ounces, they're not having to invest the same capital expenditure development that they do. It's very easy. They're very incentivized to bring that through. And so if you look at the recent acquisition of Teranga by Endeavour, that puts one of our royalties in the hands of a top 10 gold miner globally. And again, that's one of the real differences with us: good quality assets, good quality counterparties. And Endeavour announced very recently $12 million exploration spend on Wang Yon for the remainder of 2021. And that is the second highest exploration spend of any of the assets in their portfolio. So it gives you an indication of the exploration upside they see in it. And for us, that mine, if it has a 9-year mine life, roughly speaking, looking forwards, then I think we'll see over the course of this year really good results coming out of that. And the good thing is that when you see results coming out on an existing mine, it stands a very high chance that that will actually be mined, come through to us as a royalty company. Again, lots of exploration projects, lots of developing those, advancing them, but they still have that big hurdle of building the mine and getting over to the next stage. And that's what we don't have with the majority of our royalties. And so I think that's where we really offer investors diversified revenue from the outset in a royalty company that we've shown we can grow. We've nearly doubled our revenue every year since we started the company. And again, it's in our presentation, it's public, so anyone can audit us on that. We had just over $5 million of revenue last year. So I think that's in a nutshell what you have to look forward to with Elemental.
Right. And so you talked about gold equivalency, which you're starting to report in. So what is that number currently, or what's it going to be by the end of this year on resources, whether you've got 100% or otherwise on that resource?
So we just started as of this year, started reporting in, as you mentioned, gold equivalent ounces. And for last year, 2020, we had approximately 2,900 attributable zero cost gold equivalent ounces. And that's really important as well, because sometimes if you're doing a stream, you might be paying 30 or 40% of the cost on an ongoing basis, maybe 20%, but you're paying something. These are all royalties, so we're not paying anything for these going forwards. So we had approximately 2,900 zero cost gold equivalent ounces for last year. And for 2021, we've forecast 4,000 to 4,400 gold equivalent ounces. And that's if we do nothing else. And the key thing I would highlight is that those are not, in a development project that's 2 years away, it has a lot of hurdles ahead of it. That is mostly being driven by Karlawinda, which is fully financed, and it's more than halfway through construction, coming on in the next couple of months. So it is a much lower risk number than it might be where we're talking about a whole lot of development projects.
Right. And just looking at 2 years, because a 2 year time frame, nothing wrong with looking out to that. You've got a better sense of what's going on in terms of the risk component there. I mean, how much drilling is happening? How many dollars have been spent drilling out on those projects, which you think will come good in the next 2 years?
So I suppose that it's we're just in a period where our royalty on Mercedes that Premier Gold had, they have at the end of last year they were announced the acquisition by Equinox. That's Ross Beattie's vehicle. So that is currently going through. So we expect we'll have an update on that at some point over the course of this year. At Teranga's Wahgnion, which is now Endeavour, and that acquisition closed about a month ago. They have announced, as I said, that $12 million program. And I don't have a breakdown of what that comes into in drilling, but again, we'll see that over the coming months. On our other royalties at Karlawinda, which is the next largest, that royalty is currently being built. So I suspect that that will be the focus for the rest of this year, commissioning that, getting it up to production, getting it up to full scale production. And then we'll start to see, a bit like we did with Wahgnion, the first year is sort of mining, and then as soon as that you get to steady state, you then start adding in exploration. But in terms of, I suppose, in terms of where we see the exploration potential, one of the things I would say is that, again, unusual for a company our size in our position, but 2 of the royalties we have cover genuinely district scale land packages. So Wahgnion is a 1,000 square kilometer license package, and Mercedes is about a 700 square kilometer license package. And when we talk about the Mercedes royalty, that royalty, although the mine operates today, it doesn't start paying us till the 28th of July, 2022. So when you look at our revenue, not only do we have exploration across those assets, but the revenue, this is the first year we'll have 12 months of royalty revenue from Wahgnion. Next year will be the first year we have 12 full months of royalty revenue from Karlawinda. And then because Mercedes kicks in halfway through the year, 2023 will be the first year we have a full year of revenue from Wahgnion, from Karlawinda, and from Mercedes, if we do nothing else. And that is one of the key factors for us. We can point to mines at the stage they're at, already operating or very near to commissioning, that are going to be kicking in over the next 12 or 18 months and going to put Elemental in a very different position to where we sit today. And I think that that's our base case. If we sit here in our living room and they cut off the phone lines and they don't allow us to leave, that will happen.
Right. The markets don't like that. They want constant growth stories out there, so you're not allowed to do that. Let's talk about your finances, though, because you've got a very expensive facility in place with Sprott. You raised your 16 million. I think you closed that just in February, didn't you? Which is great. And you don't have much cash in the kitty right now. So how are you restructuring all of the above?
So we have, as it stands, just background for everyone, we have a $25 million loan facility, US dollar loan facility with Sprott Lending that has a 6-month minimum term and a 2-year max. And we have about 7 million US in cash at the moment. And in terms of what we're looking to do, I think we're looking to do very similar to what we did with Wahgnion. And we used a lending facility with Sprott then. And what we did is we had a 6 months essentially facility from Sprott Lending. It was $8.5 million US dollars at that point. And we were able to acquire the royalty, list the company, and then repay the finance facility. I think in the position we are now, one of the things we have spoken to a little bit, hinted at in the past, is that with the commissioning of our new royalty in Australia, Karlawinda, roughly doubling the revenue of the company, we're getting into the position where we believe we can set up credit facilities with some of the big Canadian banks. And that, again, really differentiates us, because not only then do we have the third highest revenue of any royalty company under $1 billion market cap, but we're then only the third royalty company under $1 billion market cap that would have credit facilities with the big Canadian banks, which you can only do if you have the kind of high quality producing assets that we have and the revenue base. And that instantly, if we do that and we don't do anything else, that saves us $1 million a year in interest costs straight away going forwards. And so if we do that and suddenly you factor in that into our valuation, it has a really positive impact. So I think that the second half of this year, as Karlawinda comes on, and if we're able to refinance the debt facility with Sprott, Elemental will be transitioning into going towards from a junior royalty company into a mid-tier royalty company. And the great thing is, as we always say, this is on the basis of what we already have done. And if you look at our revenue graph when we listed, if you looked at our revenue graph a year ago, it would look very different to where it is today. So that growth that we have put in the company, every year we have added to it. And we expect that this year we're going to be able to keep adding to it as we go.
Okay. The point I was making was it's a very expensive facility with Sprott, but it was necessary, and that's the deal you could get done. You feel now you can save yourself $1 million a year if you can get that refinanced by one of the big banks.
Yes, and it's I think it's a great tool to be able to use for us to be able to use that to get to the next stage of the company's evolution. And if we can then set up facilities with the bigger banks, we have so much more flexibility going forwards in terms of acquisitions and opportunities. So yes, there is a short-term cost to it, but it puts us in a very different place going forward. And again, it differentiates us versus most of the royalty companies in the space we're in.
Right. Okay. So I think we're agreed. It was you needed to do it. It was right for the time. Now you've moved on. You've also got to keep talking growth story here. So we get that your current portfolio is great, and there's a lot of near-term revenue, cash flow, and free cash flow as well. But you need to grow. So how do you go about structuring a company over and above? I mean, what sort of credit facility would you be talking about if you did go to one of the big Canadian banks?
I think it would initially be replacing what we already have. And then I think what you can do is, as you do further acquisitions, you can bolt on larger facilities. And I think actually you've seen that in the last 5 years with some of the other royalty companies, as they have done that similar story. In terms of the royalty opportunities we're looking at, we're, I think, looking at a whole range from a few $100,000 up to 40 million. So it's a very wide remit in terms of size. And as ever, it's largely driven by what fits us at that point in time. And I think when we listed, a lot of the feedback we got was, you've done a very good job in delivering value, but it would be, some scale and some critical mass is really important to Elemental. And I think the South32 deal fitted that mandate really well, because it will double the size of the company in terms of revenue. It will add so many ounces to the company in a tier 1 jurisdiction, which is what we didn't have at the time. And that's really important, particularly when you're talking to lenders, debt financiers. Having tier 1 facility, tier 1 jurisdiction royalties makes a real difference. So I think that now where we sit here today, we're looking at a number of probably what you'd call incremental acquisitions, but we're certainly also still continuing to look at a few that would put the company in a very different place. And I don't think there's a shortage of royalty opportunities out there. One of the questions we get asked the most is competition in the royalty space. And are you always bumping into peers? And that, I think most of the deals that we have done to date have been sourced directly by us, and deals that we sort of generated ourselves. And so in those, we're not typically coming up against other royalty companies. And then I think probably the exception, Wang Yuan and South32, where some of the bigger royalty companies, I think, were certainly interested in those. So for us, it's always been a mix of trying to find some really good value opportunistic acquisitions, as well as some of those that transform the company's future and sort of where we're at.
Yeah, okay. Look, and I guess you can't really talk to me about organic growth, or maybe you sort of have, in the sense that you're waiting to hear yourself of what that looks like. But in terms of acquisitions, again, I hear what you're saying. It's opportunistic, and there is competition. Whatever way you look at it, there's always going to be competition. Your job is to make sure you don't overpay for these things, and because that affects all of your portfolio. Yeah,
I think again, if you look at the best answer I can say is always look at what we've done today, and look at the portfolio we have, and look at the returns that we have delivered on that. And I think we've grown our share price every year at the same time as growing the size of the company. And some of the deals we're looking at now, I think are really attractive. And you mentioned earlier the gold price coming off a bit. In some ways, that actually makes it a little bit easier for a royalty company, looking at precious metals royalties opportunities in particular. And so I think we're certainly in a really good place to continue to build out the portfolio with acquisitions. I think we still very much like the opportunities that are closer to production, but there also comes a point in our evolution where we can start to build out the pipeline. And I think in the past, we had said, broadly speaking, that we wanted to get to a $10 million revenue number and have a sort of credit facility in place before we start to build out the pipeline of future opportunities. And so I think as we go every week, every month, we get closer to that, it gives us more flexibility to look at a wider range of opportunities. And actually, they would fit really well within us as well.
Okay. And what are you trading at versus your cash flow at the moment?
So we're probably trading at about, in US dollar terms, we had $5 million of gross royalty revenue in 2020. And we're currently about a US dollar 75 million market cap, give or take. And then for this year, we're looking at about $7.5 million of royalty revenue. So if you look at us for 2021, we're probably at about a 10 times revenue in where we are. And that is, I think if you look across the royalty space, that is, again, it stands out in terms of, I think, the value that we offer investors at the moment. And the key thing that I would look at as an investor is always cash flow. If you have that diversified base of revenue from the beginning, you have a much greater platform to build a company from. And I think one of the things that Pierre Lassonde always says is if people ask him, about a royalty company, he says, what were the first royalties they had? Because that really dictates how well the company can do. And our first royalty repaid us in under 2.5 years. And if you look at our royalties that we have today, we have some really high quality assets in there that are going to continue giving us money to reinvest in future opportunities as we go forwards. And so if you put Karlawinda and Wahgnion on as our two cornerstone assets, I would hope to be here in 10 years' time when we're talking again and say these two mines have the same mine life ahead of them, but they have over that time given us X million dollars to reinvest in royalty opportunities and keep building out the pipeline. Okay.
We don't hear it much from you in the marketplace. Marketing doesn't seem a priority for you. Why is that?
I think it's definitely something that we have been, I think, always aiming to do more on. And I think that now with the closing of the South32 transaction that you mentioned a few weeks ago, I think in February this year, I think it gives us a bandwidth and ability to really focus on the marketing. And the other aspect of it, of course, is that we now have more organic growth in the company's pipeline that we already own than we've ever had. So we can go out there and actually we can really, really focus on getting the message and the story out there because we have got so much royalty revenue growth coming in over the next 12 months with 18 months with Karlawinda and then with Mercedes. So I think that puts us in a better position to do it. I also think probably if you'd asked me 8 months ago when we listed last summer, if we thought that we'd still be unable to travel to Canada, we probably would have thought we'd be over there by now. So I think we're definitely itching to get over and to be able to market not just to individuals, but to brokers in person and really start to get story out there. And I think that sometimes that takes time, and I think it's taken longer with us. But with some of the catalysts that we have coming up over the next 6 months, it will really start to differentiate Elemental again on the basis of what we already have, which is a wonderful position to be in. And I think the value will really show and come through from that.
Are you going to be able to start laying out all of the portfolio for people to be able to discern where you're at with each of them? I know we talked today about the core assets and the near-term assets, but you've got a growing portfolio. You may or may not understand where each of those is in terms of its development, in terms of dollars being spent, meters being drilled, etc. Is that something that you're going to be able to share with the market?
I think every quarter that we're listed, it gets easier and easier to demonstrate to investors. So every quarter is another quarter of public track record in terms of revenue. And last year, we announced our preliminary Q 2020 numbers, and it was 5.1 million US, in line with what we had guided. And so I think that will be, again, a really good point for investors, is just, if we do what we say we've done, and then as the months go by, we can start to show Endeavour exploration at Wang Yon. We can start to show Karlawinda coming on stream. We can, see as Equinox advance with Mercedes, all of these really positive things. I think will start to add a lot of value, and even on some of our other royalties at Austral Gold, Zamankaya in Chile, they had a really good exploration update recently, and some really good hits, and that's our highest royalty by percentage, 2.25% NSR. So I think as time goes by, it gets easier and easier to point to some of the exploration and then the read-through value that it adds to Elemental shareholders.
That's what I want. That's what we're getting at, Fred. Is it's more about the rest of the portfolio, that we can see over time how each of the assets in your portfolio of companies is developing or not. And I think some of the larger companies are doing this as a matter of course. And I would encourage royalty companies across the board to be more open with the data that they share with the public. Certainly allowing us to see how you are moving forward, how the projects and portfolio is developing.
Yeah, and that's actually, again, one of the big benefits of having predominantly producing assets is that they're reporting their own quarterly results typically. Whether you're ASX listed or in Canada, you are typically giving quarterly results, and those quarterly results are really transparent. And so for us, when you look at the Q4 numbers as an example, you could probably get a pretty good read through on where our numbers are going to be before we even announced it, just by looking at the underlying operators. And that's something, that transparency is something that you can do with producing assets, that with some of the development assets, it's very hard to know if it will be 1 year, 2 years, or 3 years. And on the exploration side as well, one of the things that I think you can have is that when you get a very large $5 billion, $10 billion operator, sometimes they're doing really good exploration in the background, but it's not material enough for a company of that size to put all the information out on a regular basis. And so I think where we can, we definitely will. And we try and highlight where there's really good results on some of our royalties, so that investors can see it as well. Right.
Okay. So that's what I'm talking about. Yeah. Of course, punters can go and have a look at what everyone else is doing, but collating 100, 200 assets in one spreadsheet when you already do it seems, a fruitless exercise. So, that's what I'm saying. I'm saying you guys need to perhaps up your game and as a sector, and just help us poor minions work out the information a little bit easier. That's all I'm asking.
Yeah, it's a really good point, because one of the reason we often use the cash flow numbers for Elemental, the revenue numbers, is because when you talk about net asset value is always calculated on various, you might call it to some extent, subjective metrics. And so one person's net asset value can be very different to someone else's. What you can't fudge is you can't fudge revenue. You can't fudge how much money you're getting from the royalties and when it's coming in. And that's why I think, again, Elemental, we have the third highest revenue in the sub-billion dollar royalty space. And actually, we're nowhere near the third highest market cap. We're the seventh highest market cap. And I think there's a really big difference there. And I think that when you look at revenue, you see Elemental, and you see a company that has more than covering its costs. Every year, it's going to be able to reinvest more and more in royalties. We have a really diversified portfolio with high quality operators that no other royalty company our size has. And so to be trading at the valuation we're at as one of the lowest, it's an anomaly. And that's before taking into account our biggest royalty, Australia's newest gold mine, that's coming on stream in Q2.
It's why I'm suggesting it. We've had conversations with royalty companies who are making claims about production on assets which don't even have a resource. They're saying we'll be in production within 2 years. There's no resource on the asset. So how they're going to get production and therefore a royalty in 2 years' time beggars belief. So I'd say as an industry, it'd be better if you had a less subjective view of what the numbers looked like. It would help companies like yourself who are focusing on the right thing, which is cash flow, right?
I think it really would. And I think that we sometimes hear that from investors, which is, is it better to have 20 exploration royalties or 5 or 6 producing royalties? And they're chalk and cheese. And I say it's very much like, just think of the mining industry as a whole. There are 2,000 listed exploration companies or mining companies in Canada. There's probably 100 producers. And a lot of those exploration ones are hopes and dreams. And there are some really good quality ones in there. And the future of the industry will come from exploration development. But a lot of it is hopes and dreams. And Elemental, we have some really good quality producing assets that underpin our valuation and then allow us to go out and invest in good quality exploration and development stories, but without relying on it. If it takes, this is a reason why for Elemental starting privately, this is why we focused on producing royalties from day one. Our first royalty was a producing royalty that covered our costs. We've been cash flow positive since we started the company privately. And the reason was because if you start with development royalties and instead of taking a year, they take 3 years, we're all in the mining industry. We all know that happens. Sometimes it's not anyone's fault, government, permitting, lots of things can change. But that can really impact you if you are dependent on that revenue. But if you're in the position where you have $5 or $10 million of revenue, you've got money every year, you can reinvest, then all of a sudden, if that mine, which is your 6th or 7th royalty, if that takes an extra year, yes, you'd much rather it didn't. But you know what? It's not going to really materially hurt you. It will be a year and then it will come in. You have no extra costs for that year. So that's the reason we have gone about it in the order we have done it. And it's a lot harder. Everyone out there wants growth and they really want growth in revenue. And actually, I think the only royalty company that started from scratch as a real startup that has delivered that royalty revenue growth year on year is Elemental. I think if you look at 2 of the other royalty companies, the 2 biggest sub-billion-dollar space, they were both spin-outs from majors or from existing portfolios. If you look at the ones who have started up themselves, Elemental actually stand out from everyone else in what we have been able to deliver with good quality producing royalties. And that, again, is where I would say investors should really focus when they're judging companies and assets.
Bird in the hand, Fred. That's the phrase I thought of when you were talking. Well, great. Look, great catch up. Nice to see things moving forward like this. Look forward to, let's see those numbers pouring in at the end of the year for you from Australia. Hope they do.
And actually, just one thing I think possibly should touch on. Mm-hmm. And it was, I think it's a question that we had when we did the South32 transaction. And it's on that largest royalty we have, Karlawinda, that's coming on in Q2. And I think that some of the questions we had were that there is an option for BHP, so the world's first or second largest miner, to buy back that royalty or buy back up to 70% of it, of the mine, and cancel the royalty if the resource gets to 5 million ounces. And it's probably a really good, I think, sort of summary opportunity for us to summarize the position, which is that currently the mine has 2.1 million ounces. That option does not appear until it has 5 million ounces. And so if you said that in 10 years' time, they have replaced all the reserves they have mined, maybe it will be 3.5 million ounces. It's still a reasonably long way from getting to 5 million ounces. So if it gets there, it's a very good problem to have, because it will have more than doubled its resource over time. But the second, and I think really important thing, is that we're aligned with the operator in terms of not wanting to exercise that, and they control what the resource is. And the option to buy it back for BHP is 3 times the accumulative cost to date. So if this resource gets to 5 million ounces in 15 years' time, the cost of 3 times expenditure is going to be very likely in the billions of dollars for 70% of what is there, which is going to be in excess of the market cap of miner. So it's not an economic option to pull in. And the history behind it is that BHP originally explored this project for nickel, and they sold it and they sold it, but they wanted a clawback in case it was a BHP-sized discovery. And that was 5 million ounces of gold or 120,000 tons of nickel. And in reality, it's a great mid-tier miner. It's going to do 120 to 140,000 ounces a year, but that's not a BHP-sized mine. And that is not, the resource where it is now is still a decade from getting to that stage. And so from that point of view, that's why the clawback was put in place. And I think that it gave us a lot of reassurance, both when we did the work on it, but also talking to the operator and their view on it, on that clawback and on the economics of it. But I flag it because talking about the royalties coming on stream, I think it's really important to just to reiterate that is not it's a risk that we don't believe is economic, and it's a risk that we don't believe would eventuate, say for the next decade at least.
Okay, thanks to whoever sent that question, and thanks for spotting it.
Yeah.
Whoever that was. Okay, well, appreciate your time today, Fred. Thanks for the update. Stay in touch. Let us know how you get on. Okay.
Much appreciate, Matt. Thanks.